Taming the High Cost of College, Episode 2.
You have kids, they grow up, and before you know it, it's time to plan for college.
Where do you start?
How much is it going to cost?
Will you qualify for financial aid?
Should you be looking into scholarships?
When will you be able to retire?
What about student loans?
The list of questions is never ending. The good news is, all the answers are right here. Welcome to the Taming the High Cost of College podcast. Here is your host, certified financial planner, Brad Baldridge.
Welcome. This is the second episode of Taming the High Cost of College. I am your host, Brad Baldridge, and today we're going to dive into a topic, need-based financial aid, and we're going to drill down deep. Last episode, my very first episode, was a broad overview of all the different areas of college planning, so if you haven't caught that, you can go back and listen to that. But in this episode, we're going to talk and focus on need-based aid as the core topic today. So I'm going to get into it a lot deeper than what most of you have probably ever heard. It's going to be much more than, for aid, you should fill out the FAFSA. I mean, that is good advice, but that's pretty basic advice. So my goal is to give you enough information so that not only can you apply for need-based aid, but you can also plan your life such that when you do apply, you might actually get more need-based aid because you understand how it works and you're able to take advantage of and understand what you should and should not be doing, and how it all applies to your particular situation. This particular episode got long, so I will do one piece today and another piece on the next episode. But in this episode, we're going to talk about how need-based aid works. I got a little in-depth, so I'm going to include a lot of examples and numbers and so forth in the show notes. If you're brand new to college planning, some of this stuff might be a little over your head, which is fine. Continue to do your work and understand how the process works. And as you learn more terminology, come back to this in 6 months or a year, especially if you've got that kind of time, and revisit it and learn more about it then. Now, some of you are deep into it, and the terminology and so forth will be a little easier to understand. And again, if you need to, you can get to the show notes and get some of this stuff in writing as well, and you can listen to it multiple times. In the second part, I'm going to cover the various types of financial aid if you qualify. So in that episode, we're going to get into what is the PLUS loan and the Stafford. We also have Brad Recommends, and at Brad Recommends, we're going to get into college fairs. So without much further ado, let's just go ahead and jump into it. All right, so let's talk about need-based financial aid. I guess before I get into need-based financial aid, I want to talk about financial aid in general and how financial aid is actually divided into two different categories. There's need-based aid, which most of us are at least a little bit familiar with, which has to do with the income and assets of mom and dad and the student. And basically, it's based on your ability to pay for college and your finances. If your finances are relatively low to the cost of college, then colleges will provide you additional funds, and they call that need-based aid. The flip side to need-based aid and the other type of financial aid is merit aid. Merit aid is what we're familiar with when we hear of people that were an academic superstar and they were able to win some sort of scholarship, or they played a sport and won a scholarship, or there's many different reasons, if they had a musical talent. So there's lots of different ways that you can get merit aid as well. Merit aid is a pretty substantial topic in and of itself, and we'll cover that in some other podcast. But I just want you to understand that the broader category is financial aid. Financial aid can be divided into two subcategories: need-based financial aid, which we're going to delve into today, and merit aid, which is a topic that we'll cover in a future podcast. All right, so let's start talking a little bit about need-based aid. Need-based aid, again, is aid that is provided to families based on the financial situation they're in. So need-based aid is targeted to families whose income and assets are such that the colleges feel that you need additional money. The need-based system has a number of components, but the first step, I think, in the process is for most families, is to figure out where you stand on the need-based scale. There are three types of families out there. Type 1 families are going to qualify for large amounts of need-based aid. Their income and assets are relatively low, and because of that, they qualify for preferred loans or grants or other types of scholarships. And because of that, if you are a Type 1 family, you want to be careful that you don't do things that will interfere with the need-based aid you would not otherwise receive. Then we have Type 2 families. Type 2 families will qualify for some need-based aid, but often it's a smaller piece of the puzzle. And type 2 families may be able to do some sort of planning and increase the amount of aid they receive. It depends on your actual situation. Most middle income families and up are either type 2 or type 3. So 2 teachers, as an example, depending on the school, probably be at type 2 or at a very low cost school, perhaps type 3. Type 1 families, again, very low income. We're talking typically income below $50,000, and they get substantial grants and so forth. We're talking income under $25,000. Type 2 families typically start about $50,000 all the way up to maybe $300,000 in income. And assets are also a piece of the puzzle as well. And then finally, we have type 3 families. Type 3 families are just not going to qualify for need-based aid, and there's not much they can do about it. So what does a type 3 family do? Well, if you know for certain you're not going to qualify for aid, and I encourage you to figure that out for certain and not just assume you're not going to, but if you've done the math and you've concluded that I'm not going to qualify for any sort of need-based aid, then you still need to do lots of college planning, just focusing on other areas. And again, these will be topics in future podcasts, but things like tax plan, merit aid, which we mentioned earlier, athletics, cash flow, investing, all kinds of different things that you can do, even though you're not going to qualify specifically for need-based aid. A lot of those strategies, like I said, will be in future podcasts. But I think for most families, you really need to understand need-based aid so that you can really determine if you're going to qualify for need-based aid. Again, as a rule of thumb, I've seen families earning $50,000 not qualify for need-based aid because they're of the schools they're attending and so forth. And I've seen families earning $300,000 qualify for need-based aid. All right, to summarize one more time, again, there's 3 types of families out there. Type 1 families will qualify for large amounts of need-based aid. Type 2 families will get some aid, but it will be a small piece of the puzzle, and often these families are still paying $10,000, $20,000, $30,000, $40,000 out of their own pocket in addition to the aid they receive. And then finally, there's type 3 families who will not qualify for any need-based aid, and they're often focusing on things like tax planning and working with the schools and merit aid and athletics. Every family needs to understand what type of family you are. Now, if we get to when do you want to find out what type of family you are, I think for most cases, you at least want to have some inkling now. I don't care if you've got a second grader, a junior in high school, or where you're at in the process, but if you have an understanding of how much aid you might qualify for, that can help you with the rest of your planning. If you know you're going to get large amounts of aid, try to avoid doing things that will mess that up. If you know you're not going to get any aid at all, then put together a savings plan or an investment plan, figure out how taxes might be working, and look at all your alternatives beyond need-based aid. All right, so how does need-based aid actually work? Need-based aid has a relatively simple formula. And by the way, I'm going to be putting a lot of this information in the show notes. So if you're driving or whatever and can't write all this down, I will have it written down for you. Just go to tamingthehighcostofcollege.com and look up the particular episode, and there should be episode number 2, and you'll be able to get the show notes there. All right, so need-based aid has a very simple formula. It's cost of attendance minus your expected family contribution equals your financial need. Again, cost of attendance minus expected family contribution equals your financial need. Now, all of that is jargon and technical, so let me explain what each of those pieces are. Cost of attendance. Cost of attendance is the technical term for the overall cost of college. In episode 1, I quoted a bunch of prices. Those prices are roughly $25,000 for a state school, roughly $40,000 to $50,000 for a typical private, $35,000 for an out-of-state state school. And again, those are ballpark numbers. A lot of schools are above or below that. But those are cost of attendance numbers. And cost of attendance is the total cost. It's tuition, room and board, books, fees, travel, insurance. What I like to say is it even includes beer and pizza. So the cost of attendance even has some personal money in there for laundry and dates and that kind of stuff. And travel, what it's going to take to get back and forth to school. So there's money allotted for the stuff that you're going to get bills for. You're going to get a bill for tuition and room and board. But there's also stuff that money that's allotted for stuff that you will not get a bill for. Things like books and travel, personal expenses, and medical. So all of that is estimated by the college, and that's a published number. Now, the reason that number is important is because when you're figuring out your financial aid, that typically is the maximum amount of aid that you can get. So if the total cost of the school you're attending is, again, total cost of attendance is $60,000, you could, as an example, get a student loan up to about $60,000, minus any other aid that you might receive. So cost of attendance is a number. It's published by all the schools. It's also available in various databases. So that's just so we're all talking about the same thing. Most of the time, it makes sense to work with cost of attendance, the entire cost. The next term I mentioned was expected family contribution, or EFC. EFC is a number that's calculated based on your financial applications. So you send in typically it's called the FAFSA, FAFSA, and based on the data that you put on that form, your expected family contribution is calculated by the computers at FAFSA. And then the final piece of the puzzle is your financial need. Financial need is the difference between cost of attendance and your expected family contribution, and the financial need is calculated by the difference of those two, and that's generally what you're eligible for as far as need-based financial aid. So let me give you an example. Let's assume you were considering a state school for $25,000. You fill out your financial aid forms and it comes back and they say your EFC is $20,000. Well, cost of attendance of $25,000 minus your EFC of $20,000 means you show a need of $5,000. Now, if that same student says, no, I'd rather go to an expensive private school, now cost of attendance instead of being $25,000 might be $50,000. So now it's $50,000 minus your EFC, which wouldn't change. It'd still be $20,000. So 50 minus 20, now you have a financial need of $30,000. Now, another important thing to note is that just because you need it doesn't mean you're going to get it. Some schools where you do the math and you need, let's say, that $30,000, some schools may not have $30,000 in aid available for you. They might say, yes, you need 30, but the best we can do is $22,000. That is especially true at most state schools where they don't have a lot of their own money to be handing out. They're working primarily with the federal financial aid programs and perhaps state financial aid programs. But anything beyond that, generally, they don't have extra money to provide for you. So again, to summarize, need-based aid is calculated. It's cost of attendance minus your expected family contribution equals your financial need. We're going to delve into this a little bit more in a few minutes, but that is the process. Now, another thing to realize is there's actually two need-based aid systems out there. There's the federal aid system that most people, again, are familiar with. That's the FAFSA, the Free Application for Federal Student Aid. Free application, you go to FAFSA.gov and you fill out the forms there. From there, they go to the college does their work and so forth. Now, there's also an institutional system, which is also called the CSS profile. Approximately 300 colleges, most of them are the name brand private colleges out there. Harvard and Yale and NYU and Boston College and Harvey Mudd and Stanford and those types of colleges, George Washington, Georgetown. Again, a lot of the big name brand schools are going to ask you to fill out an additional form called the CSS profile. Now, there's some differences between the two. And as an example, the federal program asks a lot about your income and your assets, but it does not ask about your home. In the institutional or the CSS profile, they do ask about your home and home equity. So the forms are different in that the institutional system asks more questions and gets more data. And then most colleges use a slightly different formula when they plug that data in, calculate your EFC. Now, any college that's using the CSS profile also uses the FAFSA. The reason is all colleges that hand out federal money must use the federal aid system, the FAFSA system that the government provides. Now, colleges that are handing out some of their own money in the form of grants or scholarships, they potentially would be using the CSS profile, but only for determining how much of their own scholarships they're willing to give you. So again, we need to kind of look at what the colleges we're considering are going to ask us for. There's two systems that will be available from the colleges on their website. They try not to make it a secret. It is certainly on their website in the financial aid area. There's also some lists and so forth. I will put a link to all the colleges that use the CSS profile as well. It's available on a website. So again, just be aware that there's two systems. In some states, there's, like as an example, Wisconsin, here where I live, there's only one or two schools that will even accept the CSS profile. The other 40 or 50 in the state do not require CSS profile at all. So it's, again, reserved for typically name brand, more expensive private schools. Often the more competitive schools are involved with the CSS profile. Okay, so how do they figure out what your expected family contribution is? So the formula is simple. Again, cost of attendance minus your EFC equals your financial need. But calculating your expected family contribution is a bit of a challenge. For most families, the EFC is primarily based on the income and the assets of the student, and the income and assets of the parents. And then the last big factor is the number of students in college. But the EFC is a lot like taxes, except the calculations happen in the computers at the financial aid forms. So you don't actually do the math yourself. So when you figure out your taxes, you fill out the various forms and you plug in your numbers and you add this to that, look things up on tables, and eventually you come to, this is how much taxes I owe. Now, when it comes to financial aid, all you do is provide the data. The computers at FAFSA and CSS take all the data that you provide and they calculate what your EFC is. So for most families, calculating your EFC is a black box. EFC is based on a whole lot of factors, including parents' age, the age of the student, income and assets of both mom and dad and the student, number of dependents in the household, whether or not you qualify for various tax breaks. It looks at things like child support, maintenance in divorce situations. So there's a whole lot of factors, how much you contribute to your retirement, whether or not both family members are working. So there's a lot of different components to it. But the 5 things that have the biggest impact, again, are student income, student assets, parent income, parent assets, and the number of students in college. So where do they get the income from when you fill out the FAFSA? Well, they ask you to take that from your taxes. So a typical financial aid form is being filed in the middle of your senior year of high school for your freshman year of college. And they're going to ask you to look at the prior year's taxes, and that's called your base year. So if you have a senior right now, they're going to look at the taxes that start in the middle of your junior year and in the middle of your senior year. So if we were to put some numbers on it, if your student is graduating in 2014, they're going to look at the tax year of 2013. And that is, again, called the base year. So for a lot of families, you need to start paying attention to what your taxes are going to look like starting in the middle of the junior year. So planning needs to start earlier for a lot of families. Again, they take the income from your taxes. If your student has income, they will take the student income also from the student's tax forms, and they're going to add back in any untaxed income that you have, such as things like child support and maintenance from a divorce. If it's untaxed, they would add that on. Contributions to your retirement plan. Let's say a family earns $50,000 and they choose to put $10,000 into their 401k. For tax purposes, their income would go from $50,000 to $40,000. For financial aid purposes, one of the questions they ask is, how much did you put into retirement? You say, oh, I put in $10,000. Take that $10,000 and they add it back on. So now you're right back to $50,000 when it comes to financial aid. Now, it still might be beneficial for other reasons because assets work a little bit differently. And of course, you would get tax benefits in the year that you put the money in as well. It just doesn't help as much as we would like when it comes to need-based aid. Other untaxed income that they might consider would be distributions from retirement plans and Roth IRAs, interest from tax-free municipal bonds and those types of things. So they look for quite a bit of the typical untaxed income. So that's the various income that they will draw in. Now, it's important to understand that student income is assessed more heavily than parent income. And there's also some protection amounts. Now, for parents, you look up a protection amount based on the number of people in the household and the number of college students you have. And it varies somewhere between, say, 20 and 30,000 typically. So again, it's a lot like taxes where if say your income is $60,000, they're going to start with 60, but then they're going to give you credit for things like taxes paid and a protection amount. So in the end, your $60,000, they may bring that all the way down to, say, $15,000 based on how much taxes you pay for state taxes, federal taxes, Social Security taxes. They'll also give you a credit for the number of people in your household and so forth. And once that's all done, let's say you get down to $15,000. Then they take that $15,000 and they look it up on a table for you. And it comes back with how much is going to be applied to your EFC. What is important to realize is it's based on prior tax year. So you're going to need to get your taxes done in order to be able to apply for financial aid. So let's talk about how the assets work. Not all assets are assessed, and it's easier to talk, I think, first about assets that generally do not count. Now, I'm specifically talking about the federal method here, the FAFSA, because there are differences between the CSS profile and the FAFSA, or the institutional method and the federal method. So in the federal method, which applies at all schools, there are a number of categories of assets that are not reported. And I'll go through those quick. The first big one is anything that's retirement related. So all your 401ks and IRAs, pension, profit sharing, 403b, IRAs, Roth IRAs, rollover IRAs. Again, anything that is retirement, it's called either a qualified plan or an IRA. Those big categories do not count. And anything else you might have at work, profit sharing and so forth. So again, one big category, retirement-related retirement plans. Another category that does not count is your primary residence. They don't ask about the value of your home. The flip side of it is they don't ask about the big mortgage that you may have or the big mortgage payment. Another area that doesn't count is small businesses. If you have a small business and it meets all the criteria, it has to be in the U.S., the family has to own more than 50% of the business, and if it has 100 or fewer employees, often you can exclude small businesses. So most plumbers and lawyers and doctors and contractors and those types of people, the people running small businesses, realtors, do not have to report the value of their business, and therefore they would not have to report, as an example, the equipment or the half-finished house if you're a contractor. All that stuff is out. Another large area that doesn't count are annuities and cash value life insurance. If you have money in a variable annuity, a fixed annuity, an indexed annuity, that's not reported on the federal method, as well as any cash value in your life insurance is not reported. So those are the big things that are out. So what do you report? Well, everything else. And the big categories there would be money in the bank. If you've got savings, CDs, checking accounts, all that's reported. Investments that are not in a retirement plan. If you own mutual funds or stocks or bonds or oil drilling partnerships or real estate partnerships, all those types of investments are included. Another big area would be college savings plans. If you own 529s or Coverdale college savings plans, those plans are also included when you calculate financial aid. And it's included for all the college plans that parents might own for all the kids. So if you have 4 kids and a 529 plan for each of them, say $20,000 each for a total of $80,000, you're going to have to report the entire $80,000 when you fill out financial aid. And then the last big category I think would be real estate. Real estate that is not your primary residence, you have to report. So if you have rental property, a vacation home, hunting land, if your mother-in-law's plan for her estate was to put her house in your name, now technically you need to report that as well. So those are the types of things that are going to be reported on the form as assets. You also need to report the student assets. So if a student has a savings account or a bank account, you'd need to report that as a student asset, as well as anything that's in the student's name. Usually it would be a UTMA, UTMA, or an UGMA, UGMA. Those are typically some sort of investment account where maybe there's some stocks or bonds or mutual funds in the student's name. Sometimes grandparents may set this type of thing up for grandchildren or parents for their kids. Technically, those are all assets that belong to the student and would be reported as a student asset. Now, just like for income, assets that are in the student's name have a much bigger impact on qualifying for need-based aid than if it's in the parent's name. So student assets, again, for need-based aid may not make sense. Now, if you're a type 3 family, and this is why it's important to understand, if you're a type 3 family and you're not going to qualify for need-based aid, you don't care if there's assets in the student's name. As a matter of fact, you may intentionally put assets in the student's name for other reasons. And because you're not going to get need-based aid, the answer is no need-based aid, and you put assets in the student's name, and the answer is still no need-based aid, you didn't lose anything. So you want to make sure that you understand where you are in the process to know, as an example, should you put stuff in the student's name or should you take stuff out of the student's name? And for a lot of families, the answer is yes, you should, but there is a pretty substantial exception to that. Students can also have non-reportable assets. Students technically can have IRAs and retirement plans, and students could own annuities, and students could have a primary residence. You have to remember that financial aid was designed not just for parents with 17 and 18-year-olds going off to college. It was also designed for the 50-year-old going back to college. So there's a lot of questions that may not apply for a typical parent situation, but they ask them because it could, like I said, it could be a 50-year-old going back to college who does have income and assets and a house and a family and all kinds of things, and it just works a little differently for them. Now, the focus of this program, so you're aware going forward, will be for the parent situation where parents of high school kids off to college. but occasionally I will mention differences. All right, so that is assets. So again, income they take from your tax forms and it's based on the prior year. Assets based on what you tell them, and it's based on the day you sign the form. So how do we use this information? Well, here's a couple quick examples. Let's say, hypothetically, you've got a $40,000 in your checking account, and you've built up that money on purpose because you also have a bill for $25,000 because you just put a new roof on the house. If you're about to apply for financial aid, a lot of you are already thinking this, it would make sense to pay the bill. By the way, when you pay the bill, your checking account goes from $40,000 down to $15,000 because you no longer have the bill and you no longer have the money that you paid the bill with. Now, just so you're aware as well, FAFSA does not ask about any sort of debt. So your credit cards and car loans and all that kind of stuff, none of that is ever reported. So it may make sense to pay off some of those things, especially if they're already high interest, in order to reduce your assets. Another important thing about assets, though, there's also a protection amount on assets. So not all your assets are counted. So obviously your retirement plans and all the things we talked about earlier are thrown out. Then anything after that is all added up, and there's a protection amount, again, typically between $20,000 and $40,000 for a married couple, and between $10,000 and $15,000 for a single parent, where that amount of assets doesn't count either. So let's say you have $5,000 in the bank and all the rest is in retirement. That $5,000 is not going to hurt you. Now, if you had $105,000 in the bank, your protection amount might be, say, $40,000. Then the amount over $40,000 will hurt you. Now, it's not the end of the world either. Some families, again, because you have expensive college coming up and so forth, may need to keep some assets in the bank for future bills. And in the end, you're just going to have to report small amounts of money. And sometimes there's not much you can do about it. All right, so that's income and assets. So let me give you a couple examples. I ran some calculations, and if you are a parent in this situation, again, and this is hypothetical, and this is I made a lot of assumptions, so these numbers aren't 100% accurate. I just want you to understand relatively how they work, because there's a lot of factors, again, that I did not take into account, like the age of the parents and if they're both working and so forth. But I ran an approximation on a typical family, income $75,000, parent assets $20,000, student assets $1,000, and one student in school. So again, income $75,000, parent assets $20,000. The EFC calculated to $10,500 approximately. Now, if you double the income for the parents to $150,000, the student's income is still zero, assets stay the same, still one student in college. The EFC goes up to $31,500. So in this example, the income doubled, but the EFC tripled. Okay, so based on that, let's talk a little bit more about the number of college students you have, because I mentioned the four main things, again, that I've already mentioned: income and assets of the student, income and assets of the parents. But the last large variable that has a big impact would be the number of students that the parent is supporting. Now, these need to be undergraduate students, but let's say hypothetically you've got little Johnny who's attending the local state school for $25,000, and you're that family number two who has $150,000 of income and an EFC of $31,000. Well, if you're looking at that and saying, well, wait a minute, I don't qualify for any need-based aid. It's $25,000 minus $31,000 EFC means I don't qualify for any need. Now, what happens if you add a second student is the EFC is generally divided among the students. So in that situation, instead of being $31,500, the EFC would go down to $16,000 for each student. So let's say you've got little Johnny going off to state school, and the next year, little Susie goes off to a private school for $50,000. Now, what does your family look like? Well, you have little Johnny at the state school, $25,000, with a new EFC of $16,000. So 25 minus 16, you now show a need of $9,000. And for little Susie, let's say she's at a private school that costs $50,000. Well, $50,000 minus $16,000 means she qualifies for $34,000. Now, just because you need it doesn't mean you're going to get it at that particular school, but you get the point. Now, what happens when little Johnny graduates and little Susie's by herself? Well, now you're back to one student, and the EFC goes back up to $31,500. So now for little Susie in her last year, it may be $50,000 minus $31,500 means she only needs $18,000. So it can have a pretty dramatic impact. Now, I encourage families to map out what your situation is. Some families will have their kids going to college one at a time. Well, we've got 4 years for Johnny, then we've got a couple of years off, and then we have 4 years for Susie, and then we're done. Or you can be like me. I've got 3 kids, and at one point I had 3 kids under 4 years old for a brief time. So I've got right now a 5th grader, a 4th grader, and a 1st grader. So as I start getting into it, I will have 1 in college. Then I have 2 in college for a long time. Then my oldest will graduate at the same time that my youngest starts college, so I'll continue to have 2 in college. Then my second oldest will graduate, and then I will have 1 in college as my daughter finishes up as the youngest. So if you look at that picture, you can see, depending on what year we're talking about, my financial aid calculation may be substantially different from one year to the next. All right. So that, again, is a brief overview of federal system. I'm sure you've got a lot of questions. If you do, feel free to send them to me through Facebook. You can go to tamingthehighcostofcollege.com/Facebook, and that will send you to my page. From there, you can type in questions if you have them, and I'd be happy to answer them. Another option is you can actually send me questions through voicemail by clicking the voicemail button on my website on the Contact Us page, or on the sidebar there you can see Send Brad a Message. If you record a question, I'll be happy to answer it in an upcoming episode and get back to you with that information.
The latest tips, tricks, and tools you can use today. This is Brad Recommends on Taming the High Cost of College.
For episode 2, I'm going to recommend college fairs. Now, college fairs are all over the country, sponsored by different organizations. Some are big and some are small. Probably the biggest organization operating the biggest college fairs would be NACAC, National Association for College Admission Counseling. They run, it looks to me on their website, about 60 fairs in all the greater metropolitan areas, all the way from New York all the way out to Honolulu in Hawaii. They've got lots of fairs going on spring and fall, and the attendance at a typical fair looks like about 400 colleges are at these fairs. So it's a great opportunity for families to get information from a number of colleges quickly. And it's also at these national fairs most likely to bring in schools from far and wide. So it's possible, as an example, to go to the Chicago Fair and talk with colleges from the East and West Coast that will be there. So college fairs are, like I said, a great opportunity where you can kind of get your feet wet and get involved with colleges that you might have interest in. So let me give you a couple of real quick pointers as far as how the college fairs might be of use to you. Let's assume that you're a senior and you're just about ready to fill out your applications, or you're kind of in the final stages of college planning. Going to the college fair might be a great opportunity for you to connect with the 3 or 4 or 10 colleges, whatever it might be, that you intend to apply to. Get your last minute questions answered, maybe get a little advice about, what dorm to apply for, or learn a little bit more about a program that you're thinking about. And also an opportunity to let them know you're still interested and you intend to apply. It might be an opportunity to actually talk to the person that's going to be reading your application. Often colleges have representatives that work at a particular region. So the representative that comes to the Milwaukee College Fair, as an example, might be in charge of all of Wisconsin, and they're in charge of reading the applications and helping with financial aid for anybody and everybody that comes from Wisconsin. Well, that would be a good person to know as you move through the college application process. So that would be a senior. Let's say you're a junior. Maybe in a junior year, you're just starting out a little bit, where maybe you've got 3 or 4 schools you think you've visited and you now like them. It might be your opportunity to visit those schools and ask them who their competition is and who they're similar to, so that you have the opportunity perhaps to find a few more colleges that might make it onto your list. And then if you're a sophomore or younger, again, it just might be a quick opportunity to pick up some nice brochures and talk to some people and get a feel for what a big school looks like, what a small school looks like, what a faraway school might be appropriate for you. So once again, there's lots that you can do. It's appropriate, I think, certainly for seniors and juniors, sophomores that are going to be searching far and wide and need some additional help. And if you have multiple kids in your family, let's say you're going primarily because you have a senior, it wouldn't hurt if your freshman or sophomore came along. Kind of a no pressure opportunity to expose them a little bit to the colleges. All right, so that's my recommendation. Again, the big organization is NACAC. I will put a link to their website in the show notes. And again, they have about 60 fairs all over the country. Most regions, however, also have smaller, more regional fairs. I know in the Milwaukee area, as an example, WEF, Wisconsin Education Fairs, is the prominent organizer for the Wisconsin area. I noticed on a website that the Greater Denver has 2 or 3 college programs set up in their area. Again, that's all they do is just Greater Denver, and WEF just does Wisconsin. So there's probably a college fair organization in your neck of the woods as well. And if you're not sure what college fairs are going on or where they are, most likely your school counselor would have good information on where to find the fairs that would be appropriate for you. So again, get out, go see. A lot of these fairs are happening in the fall here now, and some of them would be in the spring depending on your area, but they're available year-round, so go check them out. All right, this ends episode number 2. If you'd like more information or would like to learn more, you can go to www.tamingthehighcostofcollege.com. At that website there, we have show notes on this episode as well as all of our other episodes and their show notes. You can sign up for my free newsletter. If you sign up in the next week or 2, I will send you the top websites for parents of college-bound students. Again, so that's a free resource if you sign up for our newsletter. You can also go to Facebook at tamingthehighcostofcollege.com/Facebook. That will direct you to our Facebook page. On the Facebook page, you'll be able to post a question, which I then will respond to you and give you the answer to your questions. And you can also look at other people's questions and see how I answer their questions. And finally, if you're new to podcasting or you're familiar with podcasting, you can subscribe to this podcast via iTunes if you'd like. And if you are in iTunes, I'd appreciate it if you could leave me a star rating and a written review if you could. That's all for now. See you next time at tamingthehighcostofcollege.com.
Thank you for listening to the Taming the High Cost of College podcast. Now it's time for you to take action. Head to tamingthehighcostofcollege.com for show notes, bonus content, and to leave feedback for Brad. The next step on your college journey starts now.
Brad Baldridge is a registered representative of Cambridge Investment Research and an investment advisor representative of Cambridge Investment Research Advisors, a registered investment advisor. Securities are offered through Cambridge Investment Research Incorporated, a broker-dealer and member of FINRA and SIPC. Brad owns 2 companies, Baldridge Wealth Management and Baldridge College Solutions. The Baldridge companies are not affiliated with Cambridge Investment Research.